There was no emergency meeting, no breaking news banner, and no public warning when the first trillions began quietly changing direction. Markets opened as usual, governments spoke about stability, and Europe still looked calm to anyone watching from the outside. But behind the scenes, global funds had already started doing something that usually happens only before major shifts. They weren't panicking, and they weren't reacting to a single event or sudden shock that forced their hand. Instead, they were adjusting positions slowly, accepting losses in some cases, and choosing to leave early rather than late. This is what makes the move dangerous to miss, because smart money never waits for headlines to confirm what it already sees. Trillions don't flee in chaos when systems weaken. They exit quietly while everything still appears under control. To the public, Europe still felt safe, orderly, and predictable, which made the idea of an exit seem exaggerated. But predictability can turn into a warning sign when it starts limiting future returns instead of protecting them. Global funds don't leave places because they hate them. They leave when the future feels harder to price. And Europe, more than any other major region, started sending that signal first. This was not about collapse, recession, or political drama dominating the news cycle. It was about incentives shifting in ways that made long-term commitment less attractive than it used to be. When that happens, money doesn't argue or complain, it simply reallocates and moves on. The 1.3 trillion did not vanish overnight, and it did not show up as one clean number anywhere obvious. It appeared through hundreds of decisions that all pointed in the same direction. New investments delayed, exposure reduced, and capital redirected to places with fewer unknowns ahead. To most people, nothing changed, which is why almost no one noticed the exit while it was happening. But by the time exits become visible, the most important decisions are already finished. That is why this story starts before panic, before headlines, and before public awareness. Because the most important financial exits always happen when everything still looks normal. And Europe was the first place where global funds quietly decided not to wait anymore. The most revealing detail is that global funds did not leave everywhere at once. They chose Europe first, and that choice was not accidental. When large funds prepare for long-term uncertainty, they reduce exposure where future returns are hardest to justify, not where headlines are loudest. Europe looked stable, but stability had stopped translating into clear growth paths that funds could confidently price 10 or 20 years ahead. Returns were becoming thinner, rules heavier, and adjustments slower, which made long-term forecasts increasingly uncomfortable. For global funds, uncertainty is not the enemy, unpredictability is, and Europe began offering more of the latter. Energy costs became harder to model, regulation less flexible, and political compromise slower across multiple countries. None of these factors alone caused an exit, but together they made Europe the easiest place to reduce risk quietly. Funds did not abandon Europe completely, they trimmed exposure early while markets were still calm and liquid. Leaving early allows institutions to exit without moving prices against themselves or attracting public attention. This is why the exit looks invisible, because it was designed to avoid being noticed. Other regions still offered clearer upside or faster adaptation, even if they carried more visible risk. Europe offered fewer surprises, but also fewer opportunities to outperform, which matters deeply to institutional capital. At that point, staying became a bigger risk than leaving slowly. That is when the silent exit truly began. Most people imagine an exit as panic selling, falling markets, and dramatic headlines. But that is not how large funds actually leave. In reality, smart money moves the way old empires retreated in history books, slowly, quietly, and always before the crowd notices danger. Instead of selling everything, funds stop renewing positions, let bonds expire, and quietly redirect new money elsewhere. This is described in many finance books as non-decision exits, where the most important action is choosing not to act again. Europe did not see a wave of selling, it saw a wave of hesitation that slowly turned into permanent redirection. Funds reduced exposure through routine portfolio adjustments that looked harmless to anyone not tracking the full picture. One bond not rolled over, one project postponed, one allocation cut slightly below target, repeated hundreds of times. Individually, none of these moves mattered, but together they added up to trillions, quietly leaving the future balance sheet. This pattern appears again and again in financial history, from Britain after World War II to Japan in the 1990s. In each case, money did not run away. It simply stopped believing that waiting would be rewarded. Europe began triggering that same response, not because it was collapsing, but because the future felt harder to justify. Large funds are not emotional, they are structured to avoid regret, and staying too long is the biggest regret they fear. That is why they prefer early exits with small losses over late exits during stress and public attention. A silent exit is designed to look boring because boredom protects capital better than drama ever could. By the time headlines catch up, the exits that mattered are already finished. And that is why most people only understand these moments years later, when the consequences feel permanent. This is not theory. It is how institutions are trained to behave when risk becomes structural, not temporary. Europe was not punished. It was simply reclassified in the global risk map. And once a region is reclassified, it takes decades, not speeches, to change that label again. The most surprising part is that many global funds accepted real losses on paper instead of waiting for Europe to improve. At first glance, that looks irrational because long-term investors are trained to be patient and ignore short-term pain. But patience only works when the future still promises something better than the present, and that promise started fading. Funds realized that waiting could mean being trapped later, when liquidity is worse and exits become visible and expensive. Taking a small loss early is often safer than risking a much larger loss when everyone tries to leave at once. This idea appears repeatedly in investment memoirs, where managers describe regret not from leaving early, but from staying too long. Europe's problem was not one bad year, but the feeling that several average years were likely to follow. Slow growth, rising costs, and political delays made recovery harder to time and harder to trust. For funds measured against benchmarks, underperforming quietly for years is worse than one clean, controlled exit. So they chose certainty over hope, even if that meant locking in losses that could be explained to investors. Leaving early also avoids attention because markets punish visible exits far more than quiet adjustments. Once exits become public, prices move against you and losses multiply faster than expected. By acting while everything still looked normal, funds protected themselves from that scenario. This is why the exit happened without panic, drama, or official warnings. It was not about fear, but about discipline and incentives built into modern finance. Europe did not collapse, but it stopped offering a clear reason to stay fully committed. And in capital markets, losing a clear reason is often enough to trigger a permanent shift. That is how losses were accepted calmly, while the bigger risk was avoided entirely. When money leaves a place quietly, the most important question is not why it left, but where it chose to go next. Global funds did not pull capital into cash and wait, because waiting itself carries risk in a world shaped by inflation and debt. Instead, money was redirected toward regions where decisions felt faster and long-term rules felt clearer to model. Some of it moved to North America, where growth still offered scale, and political decisions followed a single center of power. Some flowed into parts of Asia, where governments could act quickly and adjust policy without years of negotiation. Other portions went into hard assets, infrastructure, and energy projects that offered control rather than high growth. These destinations were not perfect, but they offered something Europe increasingly struggled to provide, which was clarity. Funds prefer environments where risks are obvious and priced, not hidden inside slow processes and delayed outcomes. This shift is described in investment books as a move from complexity risk to execution risk. Execution risk can be managed with planning and experience, while complexity risk often surprises even careful investors. Europe began feeling like a system where outcomes depended on too many moving parts to model confidently. That uncertainty did not scare capital, but it did push it to places where mistakes could be corrected faster. Money follows optionality, and Europe was slowly losing it, while other regions were gaining it. This does not mean Europe became irrelevant, but it stopped being the first destination for new long-term bets. Once that status changes, reversing it takes years of consistent signals, not one reform or announcement. That is why the money did not come back quickly, even when conditions seemed to stabilize. Capital already built new habits, new relationships, and new expectations elsewhere, and money, like people, rarely returns to places it already adjusted to live without. One reason this exit stays quiet is that nothing dramatic happened, and modern systems only react when something visibly breaks. There was no crash to explain on television, no emergency meeting, and no clear villain to point at in public debate. Quiet capital moves do not fit headlines because they unfold through routine decisions that look boring and technical. Another reason is that many institutions prefer silence, since admitting early exits can raise uncomfortable questions from investors. Funds rarely advertise leaving early because that draws attention and invites others to follow faster than expected. Governments also avoid talking about slow capital loss because it challenges narratives of stability and long-term confidence. It is easier to manage the story when change feels gradual and can be framed as normal adjustment. Media tends to focus on events, not absences, even though absences often matter more for the future. No headline announces a factory that was never built or an investment that quietly went somewhere else. By the time missing investment becomes visible, it is usually explained as a separate problem, not a past decision. This creates a delay between cause and effect that hides responsibility and removes urgency from the conversation. History books show this pattern clearly, but only after decades pass and outcomes become obvious. In the moment, quiet exits are always misunderstood or ignored by most of the public. That silence protects short-term calm, but it also allows long-term shifts to harden unnoticed. This is why the most important financial changes often feel invisible while they are happening, and why people only start asking questions when reversing course is already very difficult. The most important phase starts after the silent exit, when nothing collapses, but the system quietly loses its ability to recover the way it once did. At this stage, problems no longer look temporary, because even strong rebounds fail to restore the old pace of growth and confidence. Economies can survive without new investment for a while, but over time, they begin living off past momentum instead of building new one. This is when delays turn into cancellations, and temporary pauses slowly become permanent absences that no policy can easily reverse. Governments notice that stimulus works less, reforms deliver smaller gains, and every fix seems to require more effort than before. Businesses feel it through tighter margins, slower expansion, and the growing sense that risk no longer pays the way it used to. Workers experience it as fewer chances to move up, fewer new roles, and careers that stall without an obvious external shock. None of this feels like collapse, which is why it spreads quietly and lasts longer than any crisis driven by panic. This is the moment when the silent exit stops being abstract and begins shaping everyday reality. And once it reaches this phase, going back becomes far harder than anyone expects. Every system reaches a moment when quiet losses stop being theoretical and begin shaping real decisions that affect daily life and future plans. This moment does not arrive with panic or collapse, but with the slow realization that recovery no longer feels automatic or guaranteed. At first, leaders notice that growth does not return the way it used to, even after support programs and policy adjustments are applied. Economic rebounds feel weaker, shorter, and less convincing than expected, creating frustration without a clear explanation. Money that once rushed back after downturns now hesitates, waiting longer and demanding clearer incentives before committing again. This hesitation changes how governments plan, because fewer resources are available to solve problems the old way. Budgets begin shifting from investment toward maintenance, as preserving stability becomes more important than building something new. At the same time, public expectations remain shaped by the past, creating tension between what people expect and what systems can deliver. This gap slowly becomes political, even though its root cause is financial and structural rather than ideological. Businesses feel the pressure earlier, as expansion plans shrink and risk tolerance drops across entire industries. Projects that once made sense now struggle to justify themselves under tighter margins and slower demand. Innovation does not disappear, but it becomes cautious, incremental, and focused on survival instead of breakthrough growth. Workers experience this phase as stalled careers, fewer openings, and competition that feels sharper than before. Nothing dramatic happens, yet effort seems to produce smaller rewards year after year. This is when societies begin adjusting expectations downward without openly admitting that something has changed. Language shifts from opportunity to resilience, from growth to sustainability, and from expansion to protection. These words sound positive, but they often signal acceptance of tighter limits rather than preparation for renewal. Capital understands this shift immediately because it tracks incentives, not optimism or official statements. When incentives stop pointing upward, capital prepares for a long period of constrained returns. This is why the earlier silent exit matters so much at this stage, because it removes the fuel needed for recovery. Without new investment, systems rely more heavily on debt, redistribution, and short-term fixes to maintain balance. Those tools work temporarily, but they reduce flexibility and increase future pressure. Over time, choices narrow, and leaders find themselves managing consequences rather than shaping outcomes. This is the phase where delay becomes dangerous, because each year of inaction raises the cost of eventual change. History shows that systems rarely reform comfortably once they reach this point. They either accept long-term stagnation or undergo disruptive adjustments that challenge established interests. Most try to postpone the decision as long as possible, hoping conditions will improve on their own. But conditions rarely reverse once capital and incentives have already adjusted. Europe is approaching this pressure point now, not because it failed, but because it waited too long to adapt. The system still works, but it works under tighter constraints than before. And when constraints replace momentum, the future becomes harder to change than the past. This is the moment where quiet loss turns into real pressure. Not visible collapse, not crisis headlines, but a narrowing of paths that cannot be ignored forever. And once this phase begins, every decision becomes more costly, because time is no longer an ally. History shows that systems rarely stay in the pressure phase for long without being forced into a clear direction by events they no longer control. At first, leaders believe time is still on their side because nothing dramatic has happened and daily life continues without visible disruption. This belief is common because history never feels dramatic while it is unfolding, only after the consequences are already locked in. In many historical cases, from empires to modern economies, quiet capital loss always came before visible structural change. Britain after World War II still looked powerful, yet capital had already begun adjusting to a future without imperial dominance. The country did not collapse, but it spent decades managing decline instead of rebuilding momentum at the same scale as before. Japan in the 1990s followed a similar path where stability was preserved, but growth quietly disappeared for an entire generation. In both cases, money did not flee in panic. It simply stopped believing that waiting would be rewarded the way it once was. These systems entered long periods where problems were managed rather than solved, and expectations slowly adjusted downward. Europe's situation echoes these patterns closely, not because it is identical, but because incentives are shifting in familiar ways. Once capital leaves early, recovery becomes harder because the system loses flexibility and relies more on internal redistribution. That reliance creates political tension because more groups are asked to share a shrinking future rather than expanding opportunities. At first, this tension is manageable because existing wealth cushions the adjustment and delays visible conflict. Over time, however, the cushion thins, and trade-offs become harder to hide behind technical language and policy tools. History shows that this is when systems face uncomfortable choices they have postponed for too long. Either they accept long-term stagnation as the new normal, or attempt reforms that disrupt stability and protected interests. Most systems choose delay because delay feels safer than confrontation, especially in complex societies. But delay does not stop pressure, it concentrates it, making future adjustments sharper and more painful. This is why history rarely allows quiet exits to remain quiet forever. Eventually, labor markets, budgets, and demographics expose limits that can no longer be managed softly. At that point, the conversation shifts from optimism to realism, even if no one wants to admit it openly. Europe has not reached that breaking moment yet, but history suggests the path forward narrows once this phase begins. The system still has choices, but each year of inaction removes some of them permanently. This is why understanding the pressure phase matters more than predicting collapse. Collapse is rare, but long-term underperformance is common and far more damaging to everyday life. History remembers these periods not as dramatic failures, but as moments when momentum quietly slipped away. And by the time societies recognized what was lost, rebuilding it required far more sacrifice than anyone expected. That is the pattern Europe is now approaching, not suddenly, but steadily, not as a crisis, but as a narrowing of futures that history has seen many times before. When trillions leave quietly, the cost does not appear in one place or at one moment, because it spreads slowly across society over time. At first, the impact is invisible, since the people who feel it most are far from markets, headlines, and financial decision-making. Large institutions adjust early, hedge risk, and protect themselves long before consequences reach everyday life. Smaller businesses and workers feel the change much later, when options narrow and competition quietly increases. This delay creates the illusion that nothing serious is happening, even as the foundation of opportunity slowly weakens. Governments sense the pressure first through weaker tax growth and higher costs to maintain existing systems. To manage the gap, they borrow more, shift spending, or postpone investments meant to support future growth. Each decision feels temporary and reasonable, but together they move the burden forward in time. Businesses respond by freezing expansion plans and focusing on efficiency instead of innovation and risk. That choice protects margins in the short term, but reduces the number of new roles and career paths. Younger workers feel this first because growth is what creates entry points into stable systems. Careers become more competitive, not because talent disappears, but because fewer new positions are created. Wages grow more slowly, promotions take longer, and job changes become riskier than before. At the same time, older assets and established players gain relative advantage by occupying limited space. This deepens the gap between those already inside the system and those trying to move up. Housing, education, and secure employment become harder to access without any visible crisis. People begin adjusting expectations downward, often without realizing the shift is happening. They delay major decisions, choose safer paths, and accept trade-offs that once felt temporary. These adaptations stabilize society in the short term, but quietly lock in slower progress. The silent exit of capital does not destroy trust overnight, but it erodes belief in upward movement. When belief weakens, participation changes and long-term planning feels less meaningful. This is how financial decisions made far away translate into everyday limits close to home. No single group causes this outcome, and no single policy can reverse it quickly. It is the cumulative result of incentives shifting and capital choosing different futures. By the time the cost becomes obvious, it feels personal rather than financial. People blame themselves, employers, or politics, rarely seeing the deeper structural cause. That is why silent exits are so powerful and so dangerous. They transfer cost slowly, quietly, and unevenly across society. And once that transfer is complete, rebuilding opportunity becomes far harder than preserving it ever was. The most dangerous part of a silent exit is that it feels manageable for too long, convincing people that time will fix what incentives already broke. By the time consequences become obvious, capital has moved on, habits have changed, and rebuilding confidence requires far more than small adjustments. History shows that systems rarely fail loudly, but they often lose decades quietly while believing stability is the same as safety. Europe's story is not finished, but the direction is already visible to those who watch how money behaves before politics reacts. The real lesson is simple. When trillions leave quietly, the future changes first, and the present only realizes it later.